Hi, today's video is on the subject of inheritance tax. It's something we get asked a lot about, so we thought we'd cover it, quick overview of it and how it works in principle in this video. So what is inheritance tax and when is it payable? So inheritance tax is payable on your assets on death, but each person gets what you call a nil rate band up to the amount of £325,000 at the moment. Plus, if you're passing on your home to your children, if you have any, or direct descendants, you get another £175,000 worth of inheritance tax relief. So each person gets £500,000 of inheritance tax relief. Married couples get £1 million, because what happens is when one person dies, those allowances typically pass to the other person, giving a couple's allowance of £1 million. So essentially, it's anything in your estate that's over the £1 million you pay inheritance tax on, and the rate of tax is currently 40%. So some potential for some big liabilities there, given the rise in house prices over the past few years, because of course your home counts towards your estate. Although it's worth pointing out, something that doesn't count towards your estate is your pension. So if you've got personal pensions, they don't form part of your estate. So it's a good way to mitigate taxes by topping up your pensions if you can. So £1 million per couple, although the caveat with that is that if your estate goes over £2 million, the residential nil rate band starts to get reduced by £1 for every two that's over £2 million. So it's possible to lose your residential nil rate band if you've got a large estate, and that's something we can help people calculate and help to mitigate if need be. So what are ways of mitigating inheritance tax? Gifts is a kind of straightforward one, where you can do gifts. Gifts are out with the estate after 7 years. They're potentially exempt transfers is the technical names. It's possible to gift as large a sum as you want, but you need to live for 7 years in order for it not to form part of your estate. There is something we look at called gifts out of surplus income. So if you're in retirement and you're still working, and you're able to demonstrate your standard of living isn't affected by giving money away on a monthly basis, it's possible to gift money away that way and it not count towards your inheritance tax reliefs either. There is the annual gift exemption as well, which you can use each year. It's £3,000 that you can use. If you've not used the previous years, you can use that up. You're allowed to go back 1 year. So gifts is a fairly straightforward one, although if you've got a big inheritance tax liability, perhaps that's not going to make too much of a dent in it unless you do a particularly large gift. So other ways we look to mitigate inheritance tax are using pensions. As I've said, don't form part of the estate for inheritance tax purposes. So if it's possible to build up big pension pots, great, because they don't form part of the estate. And if you have built up a large pension pot, possibly that's something we look at spending last once you're in retirement, because say you've built up ISAs as well and other forms of savings, and we maybe look to use the pensions last just because they're inheritance tax efficient. Other things we look to are things called AIM portfolios, which qualify for business relief. AIM portfolios invest in the AIM stock market, and if you're not familiar with that, the AIM stock market, it's out with, we've got the FTSE 100 in the UK and then the 250 below that, but there's an AIM index called the Alternative Investment Market, which tends to be for smaller companies, although that's not always the case. For the UK government many years ago, to get people to invest rather in smaller companies, they brought out some attractive tax breaks, and one is business relief. So the idea with AIM stocks is that after 2 years of holding the asset, you wouldn't pay any inheritance tax on that asset as long as it was a qualifying one. So you'd buy effectively a share portfolio, and then after 2 years, as long as you keep holding it, you don't pay any inheritance tax on the value of those shares when you pass away. Another good angle with AIM portfolios is it's possible, if you've built up cash ISAs or stocks and shares ISAs, to transfer those to AIM portfolios in later life. So the ISA still keeps its ISA status, i.e. it grows paying very little tax and no tax when you cash it in, but you can hold AIM stocks within that, so that after 2 years you don't pay any inheritance tax should you die and you've got a liability. So that's one to consider. There are other products available in the market which are called inheritance tax products essentially, and what they do is they buy qualifying assets that have got business relief attached to them. So they tend to be things like, a lot of them are energy based, clean energy, solar panels, wind farms, but also you have some that own care homes, some that get involved in asset backed finance, and others that get involved with like tech companies. So there's quite a broad selection of assets to choose from. And that's something that we do regularly, is research the market, and they work just the same as AIM stocks. Once you've held the asset for 2 years, it doesn't count towards you don't pay inheritance tax on that. It does still count towards the value of your estate for inheritance tax, but you don't pay tax on whatever you hold in those assets. So that's worth considering. We also look at trusts for clients, and if you've got a solicitor, we'd work hand in hand with a solicitor. There's different trusts that you can select, too many probably to go through in a short video, but we've got discretionary trusts where the person setting up the trust has a discretion as to who the benefits are paid to and when, or you've got absolute trusts where the money's put in the trust are given to someone absolutely and there's no flexibility. So there's different options you can look at with trust, and that's something we would talk to your solicitor about. The other option for it is out with pensions is insurance. So just simple insurance, just to actually reduce the amount of tax. So if we get to a point where there's not much you can do about your inheritance tax liability, you can look at simple things like a term assurance, which you probably had if you have a mortgage or had one. You pick a date to when the insurance runs for, and it means should you die within that period, that there's a lump sum paid out. The other one we can look at is whole of life, which, as the name suggests, lasts for the whole of your life. You pay a premium, and whenever you die, a lump sum's payable to your estate, which we would make sure was held in trust so it didn't form part of your estate, but that lump sum can be used to offset the inheritance tax liability that your beneficiaries would likely to be receive. So usually when we mitigate inheritance tax, it involves a combination of all of those different ideas to help to reduce tax or mitigate it completely. So if you have any questions, please don't hesitate to get in touch. Okay, thank you.